Obviously, the Boeing MAX ripples are running through the airline industry. Let's get reaction to what we just heard from today's results, not only from AMR, but also from Southwest Air. Joseph DeNardi is here. He's the managing director at Stifel. Joe, what do you think? Better than expected numbers, but it's really the unknown factor. When is the 737 MAX going to be back in the air?
Yeah, I think that's right. I mean, it seems like so far airlines continue to see a very healthy demand environment, both leisure and corporate. And that's kind of showing up in their revenue performance. But as you mentioned, I think the main overhang that investors are struggling with now is kind of what the pricing environment looks like when all this capacity that's been taken out this year comes back. I would say that there's still a fair amount of uncertainty in terms of how it ramps up next year based on Boeing's ability to recertify the MAX and then deliver those airplanes. So still unclear in terms of what capacity looks like next year.
That's a really interesting point. Capacity's down because this hasn't been there. We've heard just now from American that it's cost them about $540 million in lost ticket sales as a result. I think the number was north of 435 or 50 billion, $450 million or around that much for Southwest Airlines. But when you have less capacity, airlines are able to raise prices. So how big of a deal is this for them? How do you kind of net all of that?
Yeah, I think what investors want to see from airlines is they want to see them behave like railroads and constrain capacity and get stable pricing power and kind of compete responsibly with one another. And they got that behavior really through 2014. And that's when airline stocks did really well. Since 2015, these stocks have been relatively flat because there's been excess capacity. This year, capacity is kind of where it should be, maybe a little bit below GDP, but it's kind of an artificial constraint that's going to go away next year. And so we're assuming that when the capacity comes back, that it produces a more challenging revenue and fare environment for airlines. It's just unclear in terms of when it comes back and how quickly.
Phil?
Joe, this is Phil LeBeau. The first quarter, always the slowest of the quarters for the airlines, might be a good environment for them to bring the MAX back into service. But I've talked with a number of people in the industry, and I'm sure you have as well. Nobody's quite sure what the public reaction is going to be to these planes when they come back into service. How lumpy do you expect that transition to be, and how challenging will it be for the airlines to convince the public, yeah, these planes are safe to fly on?
Yeah, I think that's going to be a challenge. I think one of the data points that we're looking at is Allegiant Airlines. They had a PR challenge, a year or two ago, where they were featured on 60 Minutes, kind of with the implication that it wasn't a safe airline. I think it was largely unfounded. But what they saw after that was a period of probably 2 or 3 quarters where bookings were abnormally soft, and so. We're assuming something like that for Southwest and then to a lesser extent American and United. And so we would, Delta Airlines has benefited this year from taking share that Southwest has essentially given up. We're assuming that dynamic continues into next year, even when the MAX comes back.
So as a result, which stock do you like the best, if any of them? I mean, if you're worried about the pricing kind of going haywire after capacity comes back.
Yeah, I think the fundamental outlook into next year is not great. Assuming the MAX comes back kind of in a timely manner, you're going to have a period of excess capacity, and historically airline stocks haven't worked particularly well in that type of environment. Our thesis on the industry is that airlines are not really airlines. They're marketing companies. They put their logo on the corner of a credit card and clip 2% of the spend on the portfolio. And the market is kind of improperly valuing that like a low-quality industrial. So we're hopeful over time that airlines like Delta can better educate the market, help them see that not all of the earnings comes from running a capital-intensive, competitive, cyclical airline, that essentially within Delta Airlines is a business that looks like Marriott, and should be valued that way. And so that's why we remain bullish. And personally, I think that's part of Warren Buffett's thesis on the group. He's been Amex's largest shareholder for 30 years. It's not impossible to see that Amex is losing money because Delta is making more from that partnership. And so that's why we're still bullish on the industry longer term. I think the assets are just mispriced.
Do you like Delta better than the others as a result?
Yeah, I think Delta is probably the optimal combination of high-quality airline business, investment-grade balance sheet, very, very good management team, and then an incredibly lucrative partnership with American Express. And Amex is probably the best bank partner at this point. And then on the other end of the spectrum is probably American Airlines. They've got the richest economics with their credit card partners, Citi and Barclays. But then that gets combined with a very low quality, at least at this point, a very low quality core airline business with a lot of financial leverage. And so if Doug Parker can figure out how to improve financial performance at American, there's enormous upside there. I think investors are, they've been frustrated with kind of the lack of progress there recently.